It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. Today I really want to talk about some of the most common questions, misunderstandings I run into on a consistent and regular basis regarding the Your Personal Bank concept. The reason I keep coming back to the same topics is I find it interesting, I should say, that people that, when I speak with them, and I'm really referring to the questions I get when I first meet with folks. Most of the time they've been listening to the show, they've been introduced to the idea. They're very intrigued, oftentimes, or have a lot of interest, have a lot of good, genuine questions. But I find it so interesting that some of these same questions keep popping up over and over and over again. And I'd say there's probably three major ones that really come up. And those three have to do with, cost of insurance, the ability to qualify for the insurance, and then the bank line of credit in terms of the interest, how that really works. So I'm going to touch on those three things in depth today, and hopefully this should answer a lot of folks' questions. I'm even going to use this probably as recommended listening for somebody to listen to even perhaps before they talk to me. But certainly contact me if you do have further questions at yourpersonalbank.com. Schedule a no cost, no obligation consultation anytime you'd like on the calendar when it's available. I'd be happy to talk to you about it. So let's talk about these three most common misconceptions or questions that come up constantly with the Your Personal Bank concept. The first one has to do with cost of insurance, that question that just comes up all the time. And this one, I think, comes from the whole idea of people not understanding that we're maximizing cash and minimizing the death benefit, or really not fully grasping what we're doing there. Again, we're maximizing cash, not the death benefit. See, it's the complete opposite of what most people think of when they think of life insurance. I find it amazingly how pervasive it is that people only realize or seem to think that insurance can do one thing, and that is provide death benefit protection. Now, certainly life insurance can do that, and if that's your primary goal or your focus, well, it's a great tool for accomplishing that. I think that's pretty much universally understood. But what a lot of people don't realize, and I find an amazingly small number of people realize, that life insurance can also grow cash. You can earn dividends. You can earn dividends on your money up to 6. We got companies paying 6% dividends even today, and have never missed dividends since literally before the Civil War. It's shocking how often I run into people who are surprised by that. That these companies have been paying these dividends, these long tax, you can set it up correctly so it's tax-free, by the way. 6% tax-free consistently over the long term. And by the way, that's on the low end of the range because of the low interest rate environment. I mean, historically, these things have been paying 7-8% dividends in a normal interest rate environment. I can show you the charts and show you the history of what all these different companies have been paying. But the fact that I find it so common that people are surprised by that, I find that a bit shocking. It just tells me that the insurance industry has done a terrible job of advertising or educating people on what they actually do. You can earn solid, consistent, strong dividends, and they've been doing this for, many of these companies, not only decades, but literally for well over 100 years, over 150 years in many cases. So the thing is, you can grow your money with an insurance policy if it's structured correctly. And I don't know why so few people understand that or are surprised by that. Maybe it's the buy term, invest the rest mantra that became so popular with A.L. Williams and then later Prime America. It's almost like a bunch of lemmings jumping over the mountain, if you know what I'm saying. It just seems to be so pervasive. It's almost cult-like, if you know what I'm trying to say. It's not always actually accurate or true. That is not necessarily the best way to go for many, many people. But you hear the mantra, and you hear it over and over again, and I guess if you hear it enough, frequently enough, things become, truths in many people's minds. The reality is, by buy term, invest the rest, has not worked for a large percentage of people. The statistics show it, studies have shown it, but yet people don't want to hear that. It's kind of interesting. I find that interesting. But anyway, again, life insurance can do a lot of things. It can provide growth on your money, dividends, like I stated earlier, 6% plus for the last 25 plus years. Never miss a dividend since before the Civil War. You can do all that tax-free with guarantees and safety, which is another thing. A lot of people don't realize that you can grow your money safely without market risk. That's a big deal to a lot of people, but they have no idea that this can actually accomplish that. So if you want to take a portion of your money and protect it from risk, which I talk to a lot of people who are concerned that we're in another bubble, market bubble. We'll see. But certainly, the stock market has been at or near all-time highs consistently for some time now. So there is a lot of concern, and rightly so, I believe, for a lot of folks. A way to diversify risk, minimize risk, or create a different bucket. The other one that's a little bit known is the tax-free aspects. That's powerful, especially if you believe tax rates might be higher in the future. Our current administration keeps talking about raising taxes, of course. If you believe that to be true, then looking at tax-free options just makes sense in terms of growing your money tax-free and accessing and using it tax-free. So life insurance is one of the best options, one of the best tools, most effective to accomplish tax-free growth. Another one a lot of people don't realize is that insurance can provide monies for long-term care type of expenses. I ask people this question all the time. Do you have any long-term care insurance? And it's shocking how few do. The statistics show that something like 4 to 5% of Americans don't or do have it, which means 95% plus don't. And statistics again show that the number one expense for the typical retired couple, or retired individual for that matter, is long-term care type of expenses. It's a big risk. And I'm not saying this to scare anyone, but again, the statistics show if you're a 65-year-old couple, there's a 75% chance one of the partners is going to need long-term care, and the average cost as of about 3 years ago was a little over $250,000. And look, if you had a $250,000 expense, would that impact your retirement in a negative way? And the answer for a lot of people is yes, it would. Not everyone, but certainly a lot of people that would affect. And this is a way to provide protection for that without any additional cost. You can grow your money, get the dividends, grow it on a tax-free basis, access it tax-free, and without market risk. And if you do need money for long-term care, you have funds available for it. And if you don't, you didn't pay extra for it. So what could be better than that? And then the last one, of course, is the one most people are familiar with. Actually, the second to last one is the death benefit. We're focused on maximizing cash growth with these policies and minimizing the death benefit in most cases. But I do have people that come to me, like a couple I spoke to yesterday, who had some death benefit protection needs. Look, we can structure these to maximize cash growth all the way and minimize the death benefit all the way to the tax rules, what they allow. But if somebody has some death benefit protection needs, we can adjust those ratios like a teeter-totter. If you think of putting cash on one side, death benefit on the other, we can adjust that teeter-totter accordingly to someone's needs. So maybe they're not maximizing their cash growth to the full capability of what it can do, but they're doing it because they need some death benefit protection. So we pull a little bit of that cash growth back, a small percentage of it, small portion of it, to give that extra death benefit protection, at least for the time period that person does need it. We can accomplish that, okay? But the last one, and in my opinion, the most powerful one, is really the crux of the matter. Here's the key point with the personal bank concept. It's the ability to earn you do earn money compound, but it's the ability to access monies and earn interest on those dollars that you spend by keeping the difference, the positive arbitrage you gain. Again, today we have companies paying up between 5.75 and 6% dividends, And we have banks that are charging 3 to 3.25%, up to 3.95 on smaller cases, interest on the funds when you access them. Look, here's the thing. If you're making upwards of 6% dividends and then you access it and you're getting charged somewhere in the 3% range for interest when you access the money, what's your money doing for you? And the answer is very simple. It's still growing. You're still earning the difference. Most people that I work with are earning somewhere around the 2 to 3%, 2.5% is the most common, percent positive arbitrage. And if there's one takeaway, listening to me, I share this with everybody I talk to. If there's one takeaway you get, now I want you to pause just for 5 seconds and listen to what I'm going to say here. The takeaway that I want you to get from me sharing all this is the positive arbitrage you get. Now, there's a difference between the dividends you're earning and the interest you're getting charged is on money you spent. Folks, think about that a minute. That's the big takeaway. This is on money you actually used, allocated, or spent. What did you do with those dollars? Anything you want. Maybe you paid off some debt. Maybe you purchased something. Maybe you took the dollars and invested in something. It doesn't matter. The key is if you're you're earning, say, 2 to 3% positive arbitrage, which is what we see on a regular basis. And by the way, that is historical averages. That's the other question I get often. What about in the future when interest rates change? It's all relative. It correlates. The bottom, and I have the history to show it. I can show you the history of the last 40 years. The positive arbitrage was in place for every single month for the last 40 years, except for 2 months. And those 2 months, it happened to be the same. So you weren't getting hurt. My point is quite simple. My takeaway is quite simple. You're earning interest. You're keeping the difference on money you spent. And if you understand that, if you grasp that concept, that means, by definition, mathematically, you will have more money using the personal bank concept than not using it. It's that simple. If you're earning interest, you're keeping positive arbitrage on dollars that went out the door or were allocated elsewhere, you are going to have more money available in your pocket. Period. It's that simple. Contact me at Your Personal Bank for more information. And as always, stay tuned to the Your Personal Bank show because I'm going to talk about some of the other questions that come up often in the next segments. So don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank show with Ference Toth.
Welcome back to the Your Personal Bank show. And today I'm really talking about the most common misconceptions, questions I get, particularly from people when I first speak to them or when they first reach out to me and I first meet with them. Again, in most cases, these are folks that have been listening to the show for a period of time, or they attended one of my workshops, or did whatever it may be. But most often, it's from the radio, and they have these questions. And it's funny how I find it interesting how many of these questions just repeat themselves. And like I said in the first segment, the idea that insurance can accomplish multiple purposes, multiple goals when it comes to your money, over and above just as death benefit protection, is overwhelmingly surprising. I find it surprising that it's such a mantra, if you will, that so few people get that. Hey, you can grow your money using a policy. You can earn dividends. You can reduce your taxes. You can reduce your market risk. You can have funds available for long-term care expenses if you need them. And by the way, using the bank lines, you can get positive arbitrage. So you earn interest on money you spent. All these things, overwhelmingly, are a surprise to people when I first talk to them or when they first hear about this. And so they genuinely, it makes sense. They have questions. What I find shocking or surprising is how overwhelmingly, pervasively, the idea that insurance really has one purpose. And I don't know all the reasons behind it, but I think a lot of it has to do with that whole mantra of buy term, invest the rest. That was something A.L. Williams did back in the 1980s. And it became very popular, and it almost became like I said, a mantra. And I guess it's one of those things when if something gets repeated often enough, for many people that becomes a truth. It's not a truth. The truth of the matter is, for many people, that didn't work. The statistics show it. There's many studies that I can refer to it. A lot of people didn't invest the rest, so obviously that didn't work. Okay? And term insurance, folks, term insurance has a purpose. There's nothing wrong with it. I'm not against term, but it has a specific purpose and a specific use. And that use is to provide death benefit protection for somebody if they don't have a lot of funds to work with and they only need it for a certain period of time. The buy term, invest the rest requires someone to become self-insured, in essence, at some point down the road, because eventually term insurance becomes unaffordable because of age. So it better work. And if you don't have that protection in place, okay, and the growth in your funds or whatever, or life gets in the way, or investments don't work out like you expect, then you're taking on additional risk. It's just that simple. And you gave up that ability to have those funds available for your loved ones or for long-term care expenses if you needed them down the road. Okay, so there's a lot of reasons behind it. I'm not really here to talk about that today. I can certainly go into that at some other point. What I really want to focus on here, though, again, is the understanding that life insurance can accomplish so many more things than most people realize. Like I said, growth, getting dividends, reducing taxes, reducing market risk, having access to monies, getting positive arbitrage, monies for long-term care expenses, and a death benefit for loved ones if and when if that's a needed thing for you. I have to express it and explain it to people that, look, everything we're doing here is designed primarily to focus on maximizing cash growth, maximizing liquidity, maximizing dividends, minimizing taxes, maximizing the amount of funds you have available, and maximizing the positive arbitrage. Folks, that's the big key, the positive arbitrage. It's the ability to earn interest on money you spent, on money you allocated or used elsewhere. Look, if you take money and you invest it, and you get a certain rate of return on that investment, but then you add the positive arbitrage aspect to it, so you pick up an extra 2 or 3% return on your investment because of the positive arbitrage your personal bank provides. How can you not have more money? How can you not have more money available? You see what I'm trying to say? That's the part that the average investor, the average person doesn't get or doesn't realize. And that's why it's exciting when I talk to them or when they start listening to the show or we share with them how that can be done. Look, when you talk about institutional investors, very sophisticated investors, I'm talking about banks, institutional investors, family offices, things like that. They understand this completely. They do this on a regular basis. It's very common. It's well understood. It's not in the average investor world. That's part of the reason, that is a big reason of why I do the radio show, to bring this level of understanding, I should say, this ability to understand that you can make your money work for you more than once. You don't have to just put it away, invest it in something, and hope it works out. Obviously, should you invest in stuff? Absolutely. I'm not against that. But my point is, you can make your money work twice for you, 3 times for you. Get it to work for you even after you spend it and use it for other purposes. We all spend money. You can get your money, you can continue to have your money growing for you even after you spend it. And once you understand that, I get this all the time. Wow, where has this been my whole life? Why didn't I know about this sooner? This is a no-brainer. These are the comments I hear from people on a regular basis. I do more educating and help on the radio show here than I do when I talk to somebody individually. Of course, I explain things and answer questions. But as far as once I explain it, it clicks. the light bulb comes on. They're like, this makes sense. This just makes total sense. I had no idea I could do this with my money. And most people move forward and decide. It's not like I have to sell them on the idea, if you know what I'm trying to say. Once folks do really understand that you can gain positive arbitrage on your money can keep growing for you even after it's gone out of your pocket because you spent it or used it elsewhere. It does. It becomes one of those things that, why wouldn't I do this? And I get the question all the time, why doesn't everybody do it? I'm like, they should. In my opinion, they really should, but they're not aware of it. They don't understand it. Whatever. There's a lot of reasons behind it, right? But my point is simple. We're using insurance in a far different way, completely the opposite, in fact, of how most people view and understand insurance. I tell folks all the time, throw everything you know about insurance or your perceptions or your understanding about insurance and throw it out the window because we're doing the opposite. We're growing our money to have more cash, to have more cash value, to gain more dividends, to have more money in our pocket, to have more liquidity, to gain that positive arbitrage. And then, yes, on top of all that, there is a death benefit for loved ones. There is monies for long-term care expenses if you need them. There are those things in place that people are more familiar with. That's the cool thing. So I guess what I did, I really wanted to hit on that first one really hard because the thing is, I get it almost so often. And again, I'm breaking a misconception or a mantra out there that's so pervasive that we need to help people understand there are other ways. There are better ways to operate. You don't have to do things the way you've always done them. You know what I'm trying to say? So stay tuned in the next segment. I'm going to talk about a couple of the other questions I get so often about the personal bank concept and how it works to help you better understand this and show you how it can maximize and enhance your financial future. So stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to Your Personal Bank Show. And okay, we've really been talking about how the Your Personal Bank concept, we've been talking about this strongly today, is the insurance products that we use are structured and designed so differently than what most people are familiar with about insurance. Again, we're designed to maximize cash and minimize death benefit. That's the opposite of how most people use insurance and how they view it. Now, that brings to the next question is, well, what about, again, this comes down to the same idea, what is the cost of insurance? Because again, somebody's still thinking about the traditional use of insurance. First thing I want to tell you is this. When we're designing these products to maximize cash, we are maximizing 50 to 85% of the money to cash day one. We're reducing the death benefit by 50 to 85% at the same time. Again, think of a teeter-totter. Put cash on one side, death benefit on the other. Flip the teeter-totter the opposite way of how most people view it. Again, how do most people think of insurance? Low or no cash. Term has no cash, as most people know, and you're maximizing the death benefit. You know what I mean? Most people, when they're buying insurance, they want what's the least amount of premium I have to pay for the largest death benefit, right? That's how most people approach it. And if you're looking for your death benefit protection, that's what you should do. That's the right thing to do. But if you're looking to grow cash, that's the complete opposite of what you want to do. You should be saying, what's the maximum amount of cash I can put in, and what's the minimum amount the death benefit can be based on my age and health. And that's what we do. Flip the teeter-totter in the opposite way. Well, I'm going to tell you right off the bat, we reduce the death benefit by 50 to 85%, depending on your age, health, and how we structure these products. By reducing the death benefit by the 50 to 85%, we just reduced the cost of insurance by 50 to 85%, didn't we? I mean, that just makes logical sense. So we already cut the costs in half or much less than that right out the gate. Now, that's kind of interesting because one of the main objections that I run into in the financial world from other financial advisors, I hear, is, well, the cost of insurance is too high. Well, if you're cutting it in half to 85% right out the gate, you just took that off the table, didn't you? You see my point. Our focus is not to maximize insurance coverage, death benefit protection. Our focus, our goal, our purpose in most cases is to maximize cash growth. Now, again, if your needs are different, we'll talk about that. And if you have a combination need, we'll talk about that. We may use a combination of tools, but they're different. Maximizing death benefit and maximizing cash are two different approaches. We're probably going to use two different tools, two different insurance tools. They're completely different animals, folks. A lot of advisors, or even a lot of insurance agents, are not very familiar with using these different tools for these different purposes. And again, I fault the insurance industry has done a horrendous job of educating agents, much less the public, on the different aspects and the ways the different tools can be used. They've done an absolutely horrid job of it, in my opinion. That's why I do the show, to educate folks, to help them understand there are other options. So we've reduced the cost of insurance by a significant portion. There's other things we can do in structuring it, the policy, depending on how they're funded, to either bring the death benefits down even further in future years and such, so that your cost of insurance is minimized. Again, that's our goal, straight out the gate. We want to reduce the death benefit as much as possible and maximize the cash as much as possible, which reduces the cost of insurance by definition. So it pretty much takes out and by the way, there's not any out-of-pocket cost per se. The cost of the insurance actually is a portion of the dividend that you earn. They typically take a small portion of that over the lifetime of the contract to cover the cost of the insurance. And by the way, in most cases, when we run these, the overall cost of insurance is very competitive to a low-cost mutual fund, for example. So these things become very, very competitive from a fee standpoint or a cost standpoint compared to other typical financial tools that people are familiar with. So the cost of insurance is not a big issue. In fact, it's pretty minimal in most cases on the way we structure these cases, and very competitive, I'll put it that way, to other financial tools out there that people, many times, less expensive from a fee standpoint than many financial tools that people are using today and are familiar with on a regular basis. So again, we're very, very competitive in that arena. Okay? So again, don't think of insurance from a traditional standpoint of death benefit protection only. It can do a lot of things. You can grow cash. You can earn dividends. I've shared this many, many, many times. We have companies paying 6% dividends plus for the last 25 plus years and never miss a dividend since before the Civil War. Literally. That's powerful. You can get tax benefits. You can reduce your market risk. You have extra liquidity. And most importantly, guess what? You can have monies for long-term care if you need it, expenses if you need it. But guess what? You can get positive arbitrage, earn interest on money you spend. That's the key. So don't miss it in the next segment. I'm going to follow up on that further.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. We're going to wrap this up today. We're really talking about, I've been talking a lot about the most common questions, the questions I get from people when they first talk to me. And it's funny how the same questions come up over and over again. And these are people who have been listening to the show for some time often. But again, those questions really come about is really revolve around what's the type of insurance we use, how does it work, how are we maximizing cash values and minimizing the death benefit, which again is the opposite of how most people view and use insurance. If you missed it, I'm going to tell you, go to yourpersonalbank.com, listen to the previous segments. You can actually listen to any of the previous shows that we've aired on the radio. So it has different topics. I encourage you to do so. Again, it's yourpersonalbank.com. You can also contact me for more information or if you have questions. We've also talked about the cost of insurance, how by minimizing the death benefit and maximizing the cash, we're minimizing the death benefit by anywhere from 50 to 85%, depending on the case and the situation. We're reducing the cost of insurance by 50 to 85% right out the gate. So it now becomes very competitive to what many people are familiar with from a fee or basis from other financial tools, okay? So it becomes a very competitive thing. The other one that I want to throw in here real quick is for the insurance side, and then I want to jump into the bank side. is a lot of people think they're too old or unhealthy to qualify. You'd be surprised how many people, we actually qualify about 85% of the folks that submit the applications for these. And by talking to you and asking you a few basic medical questions, I can give you a pretty darn good idea whether I think you'll qualify or not, just based on experience. The vast majority of people will. I have folks who have qualified successfully up through and including age 79. I have a couple, in fact, recently qualified, both in their mid-late 70s, who this was a superior situation for them versus an annuity for income to supplement retirement income, for example, on a number of levels. So age is typically not the issue. Most people, you can get, because again, we're not trying to maximize death benefit. We're trying to grow cash, right? So because we're going for a lot less death benefit, it's easier to qualify for, and age becomes less of an issue than traditional use of insurance. Again, health-wise, same things for the same reasons. Certainly we can't get everyone qualified, but the vast majority we do. So don't let that stop you. If you have questions about it, contact me at yourpersonalbank.com. Now, the last one I want to touch on really revolves around the bank line of credit and the interest. Here's, I think, where people get kind of hung up or get a little confused maybe. And it's, from generally speaking, most people view debt as bad. We don't want to borrow money. I get it. I mean, being in debt is not a good thing. And borrowing money is something you want to avoid at all costs if possible. And generally speaking, I agree. But there is, like with any rule, there's always an exception to that rule. You know what I mean? And the exception is, an understanding about debt is understanding the difference between consumer debt and strategic debt. See, consumer debt is debt that you have to work for. If you have to go to work or you have to take some of your money to pay, from your efforts, from your business, your work, your whatever, to pay that bill, yeah, that's consumer debt. I completely agree. You want to get rid of that as soon as possible. And getting rid of all consumer debt is a positive thing in most cases. Strategic debt's different. Strategic debt is where you're getting someone else's efforts or something else, some other asset is paying that for you. And a great example of that is, that people are familiar with, is rental property. For example, if you bought a rental property, and let's say you got a mortgage to purchase that, and then let's say the rental income is in excess of your mortgage and expenses. In other words, you have a positive cash flow. It's a profitable proposition. Can you build wealth that way? And the answer is, of course. Most people understand that. You took on debt to create income, positive cash flow through a rental property, right? And we all know of cases of people, that's a very common example of people building wealth. Well, when you talk about a bank line of credit with the personal bank concept, and the cash and the policy is the collateral for the line, you're talking about a strategic debt situation. In other words, if you're earning, say, between 5.75 to 6% dividends, and you're getting charged somewhere between 3 and 3.95 interest when you access the funds, aren't you earning more than you're getting charged? The answer is yes. And again, I've got the documentation. The historicals are the positive arbitrage has been there every single month, for the last 40 years, except for 2 months, which they happen to be equal, so you didn't get hurt. So historically, you've got a positive arbitrage situation. In other words, the dividends you're earning is more than the interest you're getting charged when you do access those funds. So it comes down to the question is, do you have to pay? Here's where people get hung up. Okay, I get it. I put money in the policy, I earn dividends. Then I access the funds through the bank. Remember, are you taking the funds from the insurance company or from the bank? And the answer is you're getting the funds from the bank. Therefore, the funds you contributed to the insurance company are still there. You're going to get earned dividends on the full amount of the money you contributed. And it's going to compound over time, right? Because it's going to keep growing. So that amount of money just keeps increasing. Excuse me. The bank line, if you access funds from the bank, will you owe money? Will you owe the bank, I should say? Are they going to charge you interest? And the answer is yes. If you don't pay the interest, Will you owe money will you increase the amount you owe the bank over time? And of course the answer is yes. But here's where it gets interesting. Let's assume for a minute that you borrowed access to some money from the bank line. And let's assume for a minute you didn't pay the interest even. You didn't pay not only did you not pay the loan back, you didn't pay the interest also. And people say, well, wait, I can do that? The answer is yes. The option to not pay the interest exists as long as you don't max out your line. You have a choice. You can either pay the interest, of course, or you can tell the bank, just increase my line. And as long as you don't max it out, you give yourself a little wiggle room, that works. Because, again, each year, the dividends are going to grow faster than the interest being charged. And let's put it this way, it has done that every month for the last 40 years. All right? And currently the same way. So my point is simple. What if you did access the money? Let's say you did it to supplement retirement, so you have no intention of paying it back. Will the amount of money you owe to the bank increase over time? Yes. But the amount of dividends in the policy also increase over time and at a faster rate. Therefore, you have positive arbitrage, right? The amount you can access from the bank line increases every year because the amount of cash in the policy increases every year. Once people get that, they're like, holy cow. What this does is it gives you control of your money. It gives you the option of paying the interest or not. How would you like the ability to access money and use it for whatever purpose? Maybe you have a business purpose or an investment you want to do, or you want to purchase something, or you want to pay off a bill. And you've got the bank line, you owe interest, but you have the option of whether you want to, one, pay the principal or the interest back, or do it on your own schedule. How would you like to be in a position where you could pay something back on your own time, on your own schedule, when it made sense for you, rather than the lender dictating to you how you have to pay them back? Does that buy freedom? Does that buy flexibility? Does that give you flexibility on your money? And the answer is absolutely it does. You gain control back of your money. Folks, stop kowtowing to the lenders. Stop following their rules and putting yourself in the position where you have to perform. You have to pay them interest every single month on a loan, whether you like it or not, or the bad stuff's going to happen. They're going to come after you, right? Here you don't have that. If you say, look, I can't pay the interest this month or this quarter or this year even, whatever, you just let the bank know. Just increase my bank line. Again, as long as you gave yourself a little wiggle room. If you max borrow, okay, you're going to have to, if you borrowed 100%, which you can do, you wouldn't need to pay the interest on that point. But I always encourage people to give yourself a little wiggle room. That's all. So that you can buy yourself some flexibility. Does that make sense? You can buy yourself some control. Does that make sense? I think so. And for an awful lot of people, they think so also. So my point is, again, should you pay the interest back? If you can, of course. Should you pay the principal back? If you can, of course. Obviously, if you do that, your money grows faster. Remember, you're earning 5.75 to 6% dividends if there's no loan against it. So your money's going to grow. If you access through the bank line, it's probably going to grow in the 2 to 3% range, right? So if you can pay it back, by all means do so. Plus, you have access to more monies for the future, right? But if you can't, or you don't want to, because let's say you're supplementing retirement or whatever, my point is simple. We can structure it so you don't need to worry about it. And again, pay it back on your schedule, on your time frame, when it makes sense for you. Look, do you want to be in control or not? Do you want to be the boss of your own money or not? Do you want to take, you see what I'm trying to say? You want to take control of your financial life or not? Or would you rather have some lender dictate to you what the terms are? I would rather have the flexibility. And I think most people, most responsible people would. I mean, the devil's advocate here is some people say, well, if you give them that much flexibility and that much control, they might, make dumb decisions and mess themselves up. Okay, I get that. Can people mess themselves up making bad financial decisions? Of course we can. We all can. But here's what I also understand. By giving yourself flexibility, giving yourself options, then, because life happens, doesn't it? Stuff happens. It's not necessarily somebody making a bad decision. It's just things happen. The economic things, jobs, businesses. Stuff happens, right? When you have flexibility, when you have options, you can continue moving forward and avoid the bad stuff, the notices, the nasty letters, the red letter, you owe this, or the foreclosures, or the repossessions, and all those bad things that happen. When we don't make payments on terms that the lender dictated to us when we borrow money, right? See, I think it's far better, far better to have the options. And those are the kinds of things I deal with people, with clients on a regular basis, where they'll contact me and they'll say, hey, here's the situation I have. Some funds are due, or whatever the situation may be. And they say, hey, I can't pay the interest back, or I can't pay the loan back right now, or any number of things like that. With COVID, that happened big time, okay? Last year, I had a lot of that. And I can say with all accuracy, not one single, and I'm talking about hundreds and hundreds and hundreds of clients, not a single situation happened where they had to lapse the policy or anything like that. In fact, in many cases, the cash in the policy is what helped carry them through their financial struggle, because there was access to funds. They can stop contributions anytime. Okay. They had access to the money and received positive arbitrage. So guess what? They were borrowing money but still making money on it. And it helped them carry them through a tough time in many cases. Folks, that's awesome. And that's what the personal bank concept can do. Put you back in control of your money and your financial future. And folks, that can make a dramatic change for you, your family, and your business, if that may be the case. So contact me at yourpersonalbank.com for more information or schedule a free, no-obligation consultation. And as always, stay tuned to the Your Personal Bank Show.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.